Welcome to another interesting session with Decode with Nitin. Today we're talking about something I think pretty much everyone dreams about, financial freedom. You know, that feeling of waking up and actually owning your time. Not just like your 9 to 5, but all of it. But if you are new to this channel and want to get updates on Indian stock market, Indian advertising market, Indian finance management, motivational stories, and many more, please do subscribe to this channel. Though there is no hurry, you may do it whenever you have time for it.
Yeah, by the way, I am following this channel for a while and finding good content here. I am glad to be the part of it this time. Hope we will add value to our viewers and they can ask us more detail or their queries in comments section. We will try to answer them as soon as possible. Okay, let's start the session now. Imagine having more time for family, or maybe pursuing that passion project you've always put on, or just breathing room, peace of mind. Right, that's really the core of it.
And that's what this deep dive is all about today. We've tried to really cut through the noise for you, the listener. We've looked at a whole range of sources. Real stories from people who've actually done it, achieved financial freedom.
And also expert advice on the practical stuff like investment strategies, corporate bonds, enhanced SIPs, things like that. Our goal here is really just to pull out the absolute key insights, maybe some surprising facts and frameworks that work.
Yeah, basically a shortcut to getting you informed on this, wherever you are on the journey, whether you're just starting or, already saving hard. Okay, let's dive into fire. Financial independence. Retire early.
The popular image is like kicking back on a beach at 30, right? Doing nothing. Yeah, that's the stereotype. But the sources we looked at, they paint a very different picture. It's much deeper than just quitting work early.
So what is it really? What's the true meaning that came through? Well, the big insight is that it's not about not working necessarily. It's about owning your time, completely. Owning your time. Yeah, there was this fascinating finding in a book, 30 Lessons for a Living.
They interviewed thousands of older Americans, and a huge regret was not spending enough time with their kids when they were younger during those prime working years. Yeah, I can see that. The quote that stuck out was, "Your kids don't want your money as much as they want your time."
That really hits home, doesn't it? It really does. That's what financial independence buys you choice over your time. Precisely. But then the question always comes up. Okay, I'm 35. 40, is it too late for me?
Did I miss the boat? That's such a common fear. And the answer from our sources is a pretty resounding no, it's not too late. Really, even starting from scratch later in life. Yeah, we saw this incredible story of someone who retired at 50.
50. But they had almost zero savings at age 40. Wow. How did they manage that? It really hammers home the point that your starting age, well, it doesn't matter as much as having the vision and the commitment.
So what does matter then? What's the secret sauce? It honestly boils down to two fundamental things. Earn well and spend less. Earn well, spend less. Sounds simple. Almost too simple. Deceptively simple, right?
Right. But mastering those two is, according to our sources, the absolute biggest hurdle. It's like 90% of the battle. Why is that so hard in practice, though? We all know we should spend less than we earn.
Well, it's human nature, isn't it? Immediate gratification, lifestyle creep. That's why one interesting trick mentioned was automating your savings. Pay yourself first. Exactly. If the money is whisked away before you even see it in your main account, you sort of trick your brain.
It doesn't feel like a sacrifice. Removes the temptation. Okay, that makes sense. And you mentioned frameworks. There was a 10-year FIRE framework. Yes, a really powerful, though quite aggressive one.
Okay, the idea is if you can live on just 20% of your total compensation, your CTC. Just 20%. Yeah. And invest the other 80%. If you can do that consistently, you could potentially reach financial independence in about 10 years.
Okay. Example time. If my CTC is, say, 30 lakhs, you'd aim to live on 6 lakhs a year. The other 24 lakhs gets invested. Wow. Okay. 6 lakhs. That requires some serious discipline or a very high income to start with.
It absolutely does. It's not for everyone, but it shows the power of a high savings rate. But you know, that brings up another point. Should we be obsessed with hitting a specific number? Like, I need X crores.
Right. The fire number. Everyone talks about calculating their number. Yeah. But one of the key takeaways was that the process is actually more important than fixating on that specific number. How so?
Don't need a target? Well, yes. But that target number, it's almost guaranteed to change, because life happens. Exactly. Your living standards might go up, expenses change. You need a bigger place. Inflation.
Market returns. All of that. So the sources ask, what's the real use of stressing over a precise number today if you aren't nailing the process of saving and investing consistently? That's a really good point.
Focusing on the habit, the system, rather than a potentially moving target. Right. Getting fixated on the number can actually be paralyzing. You might get discouraged if it seems too far away, or you might delay starting until you have perfect clarity, missing out on valuable time for compounding.
So the act of doing it consistently, saving and investing, builds the momentum. Precisely. It builds the muscle, the habit. And because of building things, you mentioned earn well, spend less being 90% of the job.
Yeah. Before even thinking about stocks or bonds. That's because before you grow your money, you absolutely have to protect what you have. It sounds basic, maybe even boring, but skipping this, it can totally wipe you out.
Like building on shaky foundations. Exactly. That person who retired at 50, they admitted they made huge mistakes earlier. Didn't get term life insurance, no emergency fund, didn't save consistently.
Ouch, learning the hard way. So what are these essential protections, these pillars we need? Okay, Pillar 1, pure term life insurance. And the emphasis is on pure term. None of those combined investment products.
Just straight protection. How much? The rule of thumb is 15 to 20 times your annual salary. So if you earn 12 lakhs a year, that's 1.8 to 2.4 crores minimum. Correct. And maybe get it for about 20 years.
By then, hopefully your own investments will have grown significantly. Okay, term life. Got it. Pillar 2. Health insurance. Critical. A family floater policy is often recommended. What should we look for in that policy?
Key things. No caps or sublimits on room rent, daycare, hospitalization at home, donor expenses, and crucially, make sure it covers consumables. The consumables. Gloves, syringes, masks, they add up, right?
Massively, especially during surgeries. It can be a huge chunk of the bill, and some basic policies exclude them. So you need to check that specifically. Good tip. What else? Then, personal accident insurance.
This is different from life and health. It covers you if you have an accident, survive, but need long-term care or can't work. So it fills a gap. How much coverage there? Aim for maybe 1 to 3 crores.
Okay, and don't forget your stuff, right, vehicle and property insurance. And specifically, check for things like flood cover. We saw those images from Bangalore, cars floating in basements. Don't assume you're covered for everything.
Very true. A painful reminder for many. All right, last pillar, the emergency fund. Super important for peace of mind. How much should be in there? The recommendation is 12 months of your monthly income, and that's your pre-tax income.
12 months? That's quite a buffer. It is, but it means you're covered for almost any short-term crisis without having to sell investments at the wrong time and keep it somewhere safe and easily accessible.
Like a high-yield savings account, or maybe a liquid fund, somewhere with no risk of losing the principal. Exactly. Easily cashable, no penalties, ideally. Okay, solid foundations, protections in place.
Then we plan the goals. Then you plan, quantify them. What do you need money for, and when? Kids' education, buying a car, down payment for a house, retirement. Put actual numbers on those dreams. Yes, and crucially, adjust for inflation.
Remember that rule of thumb. Something costing 5 crores today might cost 10 crores in 10 years, assuming 7%. And inflation. Right. Got to factor that in or you'll fall short. Yeah. Okay. Foundations laid.
Goals quantified. Now for the growth engine, investments. Equitals first. Yeah, equities, mutual funds, direct stocks. They're generally seen as the fastest way to build wealth over the long haul, but they bounce around a lot, right?
The volatility scares people. It does. But the key insight, especially if you're younger, is that volatility is okay. It's normal. The absolute worst thing you can do is panic and sell when the market dips.
Easier said than done sometime. Oh, absolutely. But think back to 2008. Portfolios crashed, some by 80%. But people who held on, who stayed invested, often saw their money quadruple or more by 2012.
Patience pays off. A strong stomach and a long-term view. Now, SIPs are common advice. Systematic investment plans. Yep. Great tool, especially for regular folks who don't have time to research individual stocks, automates investing, averages out your purchase price, offers much better returns than FDs usually.
But there's this other idea mentioned, enhanced SIP or buy the dip. How does that work? Right. It's a more active approach than a standards IP. The core idea is when the market falls by a certain percentage, you invest more than your usual amount.
So you lean in when prices are lower. Exactly. Maybe your normal SIP is 10,000. If the market drops 4%, maybe you invest 40,000 that month. If it drops 6%, maybe 80,000 using multipliers. Huh. Does that actually make a big difference compared to just a regular SIP?
The data presented in one source was pretty striking. Over a period, the enhanced SIP strategy resulted in a corpus of around 80 lakhs, while the normal SIP reached about 47 lakhs. Wow, that's a huge difference.
Almost double. Even with similar underlying growth rates, the timing of the larger investments boosted the final amount significantly. But isn't there a risk? Catching a falling knife? What if it keeps falling after you buy big?
That's the fear, absolutely. And psychologically, it's tough. People also hesitate when the market's high thinking, oh, it's going to crash. Then when it does fall, they think, oh, it'll fall more. Analysis, paralysis, right. This buy the dip or enhanced SIP strategy kind of forces your hand based on pre-decided rules. It gives you a framework to deploy cash, maybe lump sums you have sitting around in pieces instead of waiting forever for the perfect bottom.
Right. This buy the dip or enhanced SIP strategy kind of forces your hand based on pre-decided rules. It gives you a framework to deploy cash, maybe lump sums you have sitting around in pieces instead of waiting forever for the perfect bottom.
So it provides discipline against those emotional traps. Okay, when choosing mutual funds, we shouldn't just look at last year's return, right? What else? Definitely not just the headline, key AGR. You need to dig deeper. Look for consistency. How do you measure consistency? Rolling returns are good. Check the 10, 15, even 20-year rolling returns if available. That shows how it performed over various market cycles. Okay, rolling returns.
What about risk? Standard deviation is a common measure, shows how much the returns typically fluctuate around the average. A lower number means a smoother ride generally. A smoother ride, okay. Then you have ratios like Sharpe and Sorkino.
They basically measure return rate relative to risk. Sortino is interesting because it focuses specifically on downside risk, the risk of losing money. So Sortino tells you how well the fund protects you when things go bad.
Kind of, yeah. Return per unit of bad risk. And then there's alpha and beta. Alpha and beta sounds like Greek. Huh. Alpha basically tells you if the fund manager is adding value. Did the fund beat its benchmark index like the Nifty 50 after accounting for risk?
A positive alpha suggests skill. So alpha is the manager's magic touch? In theory, yes. And beta tells you how sensitive the fund is to overall market movements. A beta of 1 means it moves with the market.
Higher than 1, more volatile. Lower than 1, less volatile. Okay, that's clear. Consistency, risk-adjusted return, manager skill, market sensitivity. Got it. And diversification. Don't put all eggs in one basket.
Absolutely crucial. Spread your investments across different categories: large cap, mid cap, small cap funds, maybe some flexi cap. Mix it up. Index funds, active funds. A mix can be good. One investor profile we saw used 7 different funds across 5 categories to get that diversification.
Okay, that covers equities. Now, debt instruments. You mentioned earlier that fixed deposits might not be so safe. Yeah, that was a strong statement from one source. The most insecure instrument because it doesn't beat inflation.
Because your purchasing power goes down over time. Exactly. So while the nominal amount is safe, its real value is eroding. So if not FDs for the safer part of the portfolio, what's the alternative? You mentioned corporate bonds.
Corporate bonds are a key alternative discussed. They offer the potential for fixed interest rates, sometimes quite attractive, like around 11 or 12% depending on the risk. 11-12% fixed. That sounds pretty good compared to FDs, but are they risky?
What are the myths? Good questions. There are definitely myths. Myth 1. Bonds are only for the very long term. That they're not? Not necessarily. You can find Munglands with shorter maturities. 4 months, 7 months, 10 months, lots of variety.
Okay, short-term options exist. Myth 2. That the online platforms selling them aren't safe. And the reality? If it's a SEBI-registered platform, the bonds themselves are held in your demand account, just like shares.
Ah, so you own the bond directly, not the platform. Correct. Even if the platform disappears, the bond is yours. You can see it on NSBL or CDSL. That's reassuring. Third myth, that you're locked in until maturity.
You can't sell early. Also not true. Also not true. You can sell corporate bonds before maturity on the secondary market. The issuer doesn't penalize you. But the price might fluctuate. Yes, the price you get depends on supply and demand at that moment.
You might sell at a discount or, if you're lucky, a premium, but exit is possible. Good to clear those up. So if I'm looking at a corporate bond, what are the key things I must check? The minimum due diligence.
3 main things. First, credit rating. This tells you about the perceived safety, like APA, AA. Exactly. AAA is the safest, offering maybe 7-8%. A rate might be 8-9-5%.
A rate, often seen as a sweet spot, maybe 9.5%, 11.5%. Then BBB goes higher, maybe 11-12%, but with more risk. Okay, rating first. What second? Collateral size. Is the bond backed by assets? Look for collateral that's worth more than the bond issue, like 1.1 times the amount.
It gives you some security if the company defaults. So there's something tangible backing it up. Good. And third, company financials. Check their track record. Are they consistently profitable? Look at the profit after tax, PAT.
You want to lend to a company that actually makes money, makes sense. Rating, collateral, profitability. Are there platforms that make this easier for beginners? Some platforms were mentioned, like Vint Wealth.
They highlight things like having skin in the game. They co-invest alongside users. Oh, interesting. They put their money where their mouth is. Kind of, yeah. They mentioned a 2% co-investment and having a 100% repayment track record so far, partly due to their own risk assessment team.
They also help with liquidity, finding buyers quickly if you need to sell, and offer low minimum investments, starting at like 1,000 or 10,000 rupees. Exactly, which lowers the barrier for entry quite a bit.
Thanks, this was too much to absorb, but great to absorb. I will definitely start analyzing my earnings and expenses and try to make a balance between them to get good stuff in smart investments.
Yes, you should. You must understand while you do this, initially, you might find that your returns are not too great. Sometimes maybe it goes in negative, but consistency plays the role here. You must keep investing. Let rule of compounding works for you. Give yourself a period of minimum 3 years to see returns on investments. Now, as I said in the beginning of session, I would love to answer your queries, if any. You may please share this video to your friends so that they also get to know that investment is must for life. Paisa Zarorihe.
You are absolutely right. Then the next time, let's spread knowledge and spread happiness.
Goodbye.